Good evening, everyone. Thank you for joining this evening Corporate Connect featuring Keppel Pacific Oak US REIT, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Geoff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by Mr. Dave Snyder, Chief Executive Officer and Chief Investment Officer. We will end off with a Q&A session. Keppel Pacific Oak US REIT is a distinctive office REIT listed on the main board of the SGX on 9th November 2017. Core leverages its focus on its fast-growing technology, advertising, media and information, as well as medical and healthcare sectors across key growth markets in the United States, and aims to be the first choice US office S-REIT, providing sustainable distributions and strong total returns for unit holders. Core invests in a diversified portfolio of income-producing commercial assets and real estate-related key assets in key growth markets, characterized by positive economic and office fundamentals that generally outpace the US national average and the average of a gateway cities. Its portfolio comprises a balanced mix of freehold office buildings and business campuses across key growth markets, significantly driven by technology and innovation. Without further ado, can I invite Mr. Geoff Howie to present, please? Geoff, over to you.
Thanks so much, Eileen. Good evening, ladies and gentlemen, and thanks very much for joining us. Just to reiterate, this is an education presentation. We are providing, information as to where the stock market is right now and how it has got here, looking at current drivers with a very big focus, obviously, on Keppel Oak REIT tonight that David will be presenting on very soon. But before that, just to give a very quick overview of our Singapore stock market, I promise, no more than 15 minutes, just to look at where we are this quarter so far. Pretty much, even if you just look at the last 6 weeks or so since the end of July, the Straits Times Index has spent the majority of time range bound between 3,300 and 3,200. And that's actually seen the 30-day historical volatility of the STI return to single digit below 10%. And the STI has pretty much spent 3/4 of the trading sessions right since the end of 2019 with annualized volatility actually above 10%. So this is this has been one of those rare quieter times of our STI market over the past 6 weeks or so. It brings the STI total return in the third quarter right through to the Friday close just last week to around 7% versus 5% for the developed FTSE developed index. Now, for the 2022 year to date, the STI has booked an 8% total return versus a 12% decline for the FTSE developed index. By comparison, our region, the FTSE ASEAN All Share Index, has generated a 5% total return so far this quarter, and actually a 2% decline in total return in the year to date. So as we've noted before, the real reasons why STI has performed fairly well is, number one, it has a high weightage to banks. Number two, it doesn't have much exposure to technology sector, which has been the weakest of all the sectors across the world so far this year, and hence weighed those big developed benchmarks. And number three, we have a lot of regional diversity. When you look at the actual STI constituents, close to 50% of the revenue is generated here in Singapore, with more than 40% generated across Asia Pacific outside of Singapore. So also I should mention, so far this quarter, what we've seen is Singapore stocks actually book something like 850 million Singapore dollars of net institutional inflows. It's been led by net institutional inflows to DBS, OCBC, Singtel, Keppel Corp, Singapore Airlines, Venture, Jardine Cycle and Carriage, Gunting Singapore, City Developments, and Sembcorp Industries. On a sector basis, I guess to wrap that up, you've had banks, telecommunications, consumer cyclicals, technology, industrials, utilities, as well as consumer non-cyclicals, healthcare, and real estate, excluding REITs, attracting net institutional inflows in the third quarter to date. Leading the STI last week, the trio of DBS, OCBC, and UOB, I think they averaged close to 2% gains last week, and that's taken their third quarter returns to date to around 10%. Now, together, the trio, as we said, they make up 40% of the banks, and with a combined second quarter of 6 billion Sing dollars of net interest income, basically on higher net interest margins and loan growth expected at the mid-digit, single-digit percentage range next for the whole of this year. The comparable non-interest income, I guess, as well, when you average it across the three, and the non-performing loan ratio is below 2%. I guess the regional resilience has seen that trio of banks outpace their global peers, which are up around 4% at the same time. So the three banks, as we said, have been a major reason for the STI's performance so far this quarter. Looking also, as we said, at some of the stocks that have been on the move this year, Keppel Corp is continuing to press on with its share buyback mandate. It's now bought back close to 3% of its issued shares, excluding treasury shares, on the current buyback mandate, while also obviously accelerating its execution of Vision 2030. So the share buybacks, they fund share plans, but they are also used as to help facilitate the potential merger and acquisition transactions. And I think since Keppel Corp announced its first half net profit, which was close to $500 million, up 66% year on year, there's been much activity across the subsidiaries. I think including there was a development role in Singapore's first hydrogen-ready power plant. There's been some offshore and marine contract wins, some data center acquisitions, as well as onshore wind energy investments across the subsidiaries. So you can see how that sustainable urban development theme is really working into the structural transformation of this stock. Just on the stock STI as well, one more final point. Following the recent semi-annual STI rebalance, Emperador will join the STI effective Monday, the next Monday open, the 19th of September. It will replace ComfortDelGro Corporation. So Emperador will take an indicative 0.4% weight. That's 0.4% weight in the STI. It means the banks will continue to maintain more than a 40% weightage in the STI, and the consumer non-cyclical sector will represent approximately 6% of the STI. And Emperador is Philippines' largest global liquor company. That secondary listing took effect on the 14th of July on SGX. So just to have a quick look at another important segment, manufacturing stocks still averaging $150 million to $200 million a day in daily turnover on the Singapore Exchange. And just as manufacturing, it represents this significant component of Singapore's GDP as well as Singapore's exports. These stocks with manufacturing related activity, they continue to maintain this significant role in our stock market, not just through daily turnover, but also market value. Together, there's 5 index heavyweights. That's Neo, Venture, Wilmar, Singapore Technologies Engineering, and Thai Beverage. So those 5 stocks comprise approximately half the index weights, and Neo currently maintains the highest index weight, and of course is the designer and developer of high-performance electric vehicles. It commenced its secondary listing back on 20th of May, and from its 20 May close right through to the end of last week, their share price had generated marginal gains, but it had actually maintained 90-day annualized volatility of over 70%. So the stock's obviously been a mover, and for that reason, it's averaged more than 5 million Singapore dollars a day in daily trading turnover. And the company reported last week, and the founder, who's also the CEO and chairman, noted that the second half of this year is a critical period for the company to scale up the production and delivery of multiple new automobiles, electronic vehicles, I should say. So these are the 5 heavyweights, but there's more than 100 constituents, and the index spans multiple sectors such as business services, consumer cyclicals, energy, healthcare, industrials, non-energy materials, the consumer non-cyclicals as well, and technology. And this really parallels Singapore's manufacturing activity as well, which, as we know, spans those 6 key clusters. Since the end of June, the market risks have obviously grown with the global and the regional geopolitical risks, the faster than expected monetary tightening, and the ongoing COVID containment risks. So that's reduced the overall total return of this manufacturing index since the end of 2019 through to last week to around 25%. And that was still highly competitive though. If you look over the past 2 years and 8 months or so, I think it generated 22% total return, and the FTSE ST All Share Index was up 9%, with FTSE APAC up 1%. So this was the, I guess, the more competitive aspect of the stock market in 2020 and 2021, prior to the reopening momentum that we saw across the region, and rotations that came with that, as well as the expectations for higher interest rates. Should quickly move on for a quick another 5 minutes. I promise to wrap up in 5 minutes, less than 5 minutes. Singapore's Reits, they obviously maintain a very, very significant presence in our Singapore stock market. They represent more than 10% of the total market value of Singapore listed stocks. By comparison, globally, Reits represent around 2% of the global stock market. So we have 5 times that impact here in Singapore. And the Reits also make up more than 20% of our day-to-day turnover. So both at that level, these Reits have are traded and have an impact that is a considerably higher level than what Reits maintain on the global scale. Much of the market value growth of Reits really has come down to multiple factors. Number one, average of 2 listings every year. And then there's the proactive capital management, and obviously a very vibrant appetite for this what's now a very common asset class in Singapore by you, the investors. The proactive capital management, it has clearly seen this drive to increase unit holder value, particularly in recent years. That can be through enhancing properties, recycling, divesting, or acquiring new properties. Investor enthusiasm, I guess, is also there because it's figured into this, because these acquisitions can be raised. The capital for these acquisitions can be raised through secondary fundraisings, such as placements and rights issues, in addition to the traditional means of debt. So we see this these REITs tapping the secondary market on a regular basis as they expand and optimize their portfolios. So much so that last year we saw half of the S-REITs that are listed on SGX, we have close to 40. So half of those basically announced asset acquisitions last year that were valued at around 15 billion Sing dollars. And that exceeded the $12 billion or so in total purchase price consideration. That momentum has continued somewhat this year. There's been a dozen or so REITs that have announced acquisitions over the first 8 months of this year, and that's close to around $5 billion in total purchase price consideration. So interesting, in Singapore, we've got logistic REITs that have been among the stronger segment of the REITs across APAC in the quarter to date. EC World REIT, Daiwa House, Mapletree Logistics Trust were among the 4 strongest performing S-REITs since the 30th of June. MLT, Mapletree Logistics Trust, it's continued its acquisition drive. It was one of the most active acquirers of properties last year, and it has continued that this year. But looking, I guess, at the year to date, it's been the hospitality REITs that have performed or led the performance of the REITs so far this year. Fraser's Hospitality Trust, which you may see the news today, there was a lot of trading activity and a decline based on a development in that privatisation offer, and I'll draw your attention to our company announcement page. Then you've also got Far East Hospitality Trust, CDL Hospitality Trust, Ascot Residence Trust, and then you could also, it's not a hospitality trust, but Suntec Reits there as well. Those six, basically, it's four. Sorry, those four hospitality trusts and the fifth one, Suntec Reit, have been among our strongest performing REITs so far this year. And this reopening and this fight against COVID, it has continued to, albeit maybe sometimes be in the background with the inflation and the energy prices and the geopoliticals in the headline, but it's actually this week that 7-day rolling average of daily new global confirmed COVID cases is on actual track to fall below the 500,000 cases a day threshold. That's only been seen for a dozen or so days this year, last seen in early June. So that's seen this momentum, obviously, in the reopening. We saw the Singapore Tourism Board report that the hotel's average room rate in July rose 70% year on year to a near decade high. That's extended growth for the 6th straight month on the returning global visitors. Changi Airport 2, it's going to resume operations for departure flights on the 11th of October. And I think SIA is also commencing flights to Malaysia and Thailand, then in addition to other Southeast Asian destinations. So that's what's happening in the reopening front in terms of the most recent news. In terms of interest rates, we're currently in the blackout period, which began on Saturday night, where the FOMC voters and key policymakers won't make any speeches. There is a 90% expectations now for a 75 basis point hike in the federal funds rate, which would take it to 300 to 325 basis points on September 21st. And then there are similar expectations for a 50 basis point hike at the 2nd of November meeting. And just to reiterate, our current average yield for the 40 or so REITs listed on SGX is currently around 6%. So that's still some 200 to 300 basis points above those 10-year government rates. The Fed's chair's hawkish tone last week at this Cato Q&A session, it followed that Jackson Hole narrative that inflation expectations are fueling inflation, and thus there is this need for this very strong hawkish stance now from the Fed chair and the Fed policymakers. The US CPI remains well above 2%. The headline was up 8.5% year on year in July. And in 1 hour and 10 minutes, we'll get the US August headline CPI print as well, which is due to come in, as I said, after the next hour or so. Is that it is expected to come off a little bit to 8.1%. But if that does come into expectations, market still expects a 75 basis point hike next Thursday morning at 2 a.m. Singapore time. I just want to wrap up now, but there's just one more little presentation. I didn't ask SIAS if I could have permission to flash this. I just wanted to flash it quickly because it is to do, obviously, with this super important, wonderful sector of the S-REITs, and we'll actually have our auditorium open. So if you are in town near Shenton Way on Monday night and you'd like to swing by, please do email SIAS and they can arrange a spot for you. Thank you so much. And I'll finish now and hand it over to Eileen and David. Thank you.
Thank you, Geoff. Up next, may I invite Mr. Dave Snyder joining us from the US. Good morning.
Hi, thank you,
Hi,
Eileen. Good evening to everybody. Thank you so much for joining us, and thank you, SIAS and SGX, for hosting. I will go ahead and start our presentation here on slide 4, as we'll get that keyed up. But Core is a U.S. office S-REIT with a focus on key growth markets, significantly driven by tech and innovation, mainly in the Super Sun Belt and 18-hour cities in the U.S., which offers investors an opportunity to benefit from solid U.S. office real estate fundamentals without being subject to U.S. withholding taxes, so long as the appropriate or requisite U.S. tax forms have been filed and validated. We seek to be the first choice U.S. office S-REIT, offering unit holders the opportunity to invest in a distinctive portfolio of office properties in strong locations with the right types of tenancy and with low tenant concentration risk. Some of the key things that set our REIT apart from the competition that we face. Our sponsors are Keppel Capital and Core Pacific Advisors, and our distributions are declared semi-annually in US dollars. Slide 5 provides an overview of our key milestones and achievements since our listing in 2017. We've made 5 acquisitions, namely the West Park portfolio in Redmond, Washington, Maitland Promenade 1 in Orlando, Florida, 125 in Dallas, and then we also added 2 buildings in 2021, Bridge Crossing in Nashville, Tennessee, and 105 Edgeview in Denver, Colorado, both of which are considered 18-hour cities in the US. These acquisitions have not only strengthened our presence in key growth markets, but also fortified the portfolio and our income resiliency through the COVID-19 pandemic. At the end of 2021, our portfolio value stood at $1.46 billion, and on a year-over-year basis, we have achieved growth in distributable income and DPU since inception. This next slide shows a map of our properties with some of the highlights on the right about the strength of these markets that we invest in. Most of our markets are considered magnet cities and are also referred to as Sunbelt or 18-hour cities. Here you can see that the majority of our markets are in the top 20 US markets to watch in 2022 as well. I'll now move on to our first half 2022 results. Our rental reversions remain positive, and on the leasing front, we saw strong leasing momentum as approximately 386,000 square feet of space was leased in the first half of 2022. That's equivalent to about 7.3% of our total portfolio by NLA. This brought our portfolio committed occupancy up to 92%, with only 6.3% of leases by CRI expiring during the remainder of 2022. Starting from the second quarter of 2022, we've elected to start receiving 100% of our management base fees in cash as compared to 100% in units prior to that point. We believe it makes sense to make this change now because our performance has remained strong through the pandemic, and while we expect some ups and downs in the future, given the global and economic headwinds, we do remain confident that our portfolio will continue to perform comparatively well. In addition, as we continue to trade at a discount to NAV, we believe it is in the best interest of unit holders to issue the management base fee in cash rather than units that could be considered dilutive to unit holders' value. This also should eliminate the pressure on the unit price that might be caused as the manager tries to sell its units. Finally, our leverage is low compared to our peers and well below the regulatory limit in Singapore, so we don't expect this to create any sort of leverage or balance sheet related issues. Meanwhile, we continue to maintain a strong financial position and liquidity. And I'll now elaborate a bit on that financial performance. Slide 9 provides a summary of Core's financial performance for the first half of 2022. Gross revenues and NPI were higher year on year due mainly to contributions from the 2 new acquisitions that were completed in August of 2021. As I had mentioned earlier, we've elected to receive 100% of the management fee, base fee, that is, in cash, and have provided both an actual and an adjusted DI and DPU and distribution yield figures for the respective comparative periods to provide for a like-for-like comparison. First half 2022 actual DI of $31.5 million was 5.4% higher year on year, mainly due to the 2 new acquisitions, offset by the impact from the change in management base fees in cash. Actual first half 2022 DPU was about 4.4% below the actual for first half 2021, basically due to that change in the way the management fee units are paid. However, assuming that the second quarter 2022 or 2021 management base fees were paid 100% in cash as well, actual DI for first half of 2022 would have been 11% higher year on year compared to 2021. Adjusted DI of 28.4, and actual first half 2022 DPU would have been 0.7% higher year on year, as adjusted DPU for the first half 2021 would have been about 3 US cents. Slide 10 is a snapshot of our balance sheet as of June 30, 2022, as well as two charts to show the actual and adjusted DPU figures for the first half of 2022. Separately, Coors entered into purchase and sale agreements with external parties for the sales of Powers Ferry and Northridge Center 1 and 2 in Atlanta, Georgia. The divestment of Northridge Center was completed on July 28, 2022, and the divestment of Powers Ferry is expected to close by the fourth quarter of 2022, subject to satisfaction of certain conditions. Accordingly, these two properties have been reclassified as investment properties held for sale. Moving to slide 11, Core continues to maintain a strong balance sheet with significant liquidity. All of Core's borrowings are US dollar denominated and 100% unsecured, providing the REIT funding flexibility as we continue to pursue growth. As of June 30, 2022, Core's aggregate leverage was 37.2%, with interest coverage at 4.8 times. All-in average cost of debt was 2.88% per annum, and the average term to maturity of Core's debt was 2.7 years, with no long-term debt refinancing requirements until November of 2023. We continue to manage our interest rate exposure with floating to fixed rate interest rate swaps. As of June 30, 2022, 84% of the REIT's non-current loans have been hedged, and every 50 basis point change in LIBOR or SOFR translates to an impact of about 0.062 US cents in DPU per year. On July 22nd, we entered into a syndicated term loan facility agreement to obtain a 5.5-year loan facility amounting to $180 million US. Proceeds from the new loan may be used to early refinance existing loans as well as for future acquisitions, working capital, and general corporate purposes. Assuming the refinancing of borrowings was conducted at June 30th, our all-in average cost of debt, including non-cash amortization of financing costs, would be about 3.15% per year. Excluding the non-cash amortization of financing costs, all-in cost of debt would be about 2.80% per year. The weighted average term to maturity would improve to 4.1 years, with no long-term debt refinancing requirements until November of 2024. Slide 13 shows you the key growth markets where Core operates. As I noted earlier, at the end of June 2022, our overall portfolio committed occupancy was 92%. If you exclude the Atlanta properties that are held for sale, committed occupancy for the remainder of the portfolio is a strong 93.2%. Powers Ferry and Northridge have been held since Core's listing in 2017, and they supported Core's initial distributable cash flow. As Core's portfolio size has increased, the contribution from these assets has decreased over time, constituting a combined 2.7% of the net property income of Core's portfolio at June 30 of 2022. Given how Core's portfolio has grown over the years, these smaller buildings have become less efficient to run, and hence we determined that divesting these two assets was in the best interest of our unit holders. Proceeds from the divestment may be used for short-term working capital purposes and could potentially be redeployed into other investment opportunities. Let's move to slide 14. Rent collection for the second quarter of 2022 remained high at approximately 99%, with no rent deferment requests coming in during the period. Our built-in average annual rental escalation is 2.5% on a portfolio basis, which will continue to provide organic growth for Core as we move into the future. Slide 15 highlights some of Core's geographic and industry diversification, which we continue to reiterate are some of Core's key distinguishing factors. At approximately 62% of NPI, our tech hubs of Seattle, Bellevue, Redmond, Austin, and Denver continue to drive our performance. And with over 48% of our tenants by NLA coming from the growing and defensive sectors of TAMI, technology, if you will, and medical and healthcare, we expect our portfolio will continue to perform well, even in the current environment. Turning to slide 16, our low tenant concentration risk remains another of Core's unique strengths. Our top 10 tenants remained unchanged quarter on quarter and contributed only 23.3% of our cash rental income in total. And consistent with our portfolio focus, the majority of our top 10 tenants are from established tech firms located in the fast-growing markets of Denver, Seattle, Bellevue, Redmond, and Nashville. The top tenant, Comdata, contributes only 3.4% of our portfolio cash rental income, which is a much lower percentage than our peers' top tenants contribute, which is also true for the total for all 10 combined in our portfolio. On slide 17, you'll find a comparison of the last 12 months rent growth at the national level in the US, as well as in our key growth markets and in the gateway cities. As rents continue to pick up across the US, our key growth markets have continued to outperform and saw 1.3% growth. Similarly, on slide 18, you'll see a chart that shows how growth projections have continued to pick up. CoStar's projections, and we utilize them because they provide information on all the markets in which we operate, show the US as a whole and the gateway cities' rent growth nearly catching up with our key growth markets over the next year. It will be interesting to see if they're able to actually accomplish that. However, they were hit much harder during the pandemic than our markets and will be rebounding to prior levels, while our markets in general continue to outperform. We remain well poised for recovery, with our average in-place rents approximately 7.4% below our asking rents. Slide 19 shows a comparison of the actual market rental growth against the projected 12-month rental growth for our markets at the end of June 2022. So essentially, this is showing you with the yellow dots what CoStar projected our markets would do over the last 12 months. And then the blue bars up above show you where we actually came in significantly ahead of CoStar's projections for those same periods. All of our markets have outperformed the projections, and the majority significantly outperformed. We hope that continues and that our rent growth continues to outperform overall. Turning over to the submarket outlook on the next slide, office fundamentals in Coors' key growth markets remain sound. Ongoing construction in our markets is almost all build-to-suit properties or properties that have been pre-leased. And the bulk of the construction, which you will find to be in Seattle, Bellevue, and our Redmond markets, continues to relate primarily to Amazon and Microsoft. Amazon has recently mentioned they'll be putting a pause on their construction in the Seattle Bellevue headquarters to determine how its upcoming office floor plans need to change, citing ongoing uncertainty about the impact of hybrid work. But despite this, Amazon says it still plans to deploy 25,000 new jobs in this city on the east side of Seattle. The next slide shows you some highlights, here we go, of the US economy. Based on the second estimate released in August, the US economy slowed in the second quarter, with GDP contracting at a rate of about 0.6%. The unemployment rate and the labor force participation rate both increased slightly to 3.7% and 62.4% respectively in August of 2022. Annual inflation in the US has slowed to 8.5% in July, and we just heard Geoff talking about new information that will be coming out shortly regarding that metric. The continuous surge in energy prices as a result of geopolitical tensions, coupled with ongoing supply constraints and labor shortages, is expected to cause inflation to remain elevated for some period of time at least. And to combat this, the Fed has raised interest rates, and as Geoff also mentioned, we do expect to see additional increases in the interest rate from the Fed. Moving on to slide 23. This slide shows a comparison of real GDP change at an annualized rate from the fourth quarter of 2021. Inflationary pressures, the Fed's related interest rate hikes, as well as future expectations of interest rate hikes, have triggered volatility in the stock market, coupled with the global trade issues, lack of availability of goods and components, falling consumer confidence have all worked together to create what looks to be a negative GDP growth pretty much across the board. We'll have to wait and see what happens with GDP as these other factors are going to fluctuate during the rest of the year. Given the rate increases that we expect to see, it's important to remember that Coors long-term loans have been substantially hedged with floating to fixed rate interest rate swaps, providing a significant reduction in near-term exposure to rising interest rates. On slide 24, we highlight the outlook for commercial real estate. Leasing activity in the first quarter of 2022 rose by a healthy 5.4%. As investors revise their investment plans for a post-pandemic environment, more capital is likely to be placed in the Sun Belt cities where Core is focused. The resilient Sun Belt markets are expected to continue to benefit from net domestic migration, which we have seen for a number of years in these markets. We've continued to see large conglomerates relocate their headquarters from gateway cities to suburban and generally Sun Belt markets for reasons that include low or no taxes, as well as lower costs of living. In June, billionaire Ken Griffin announced he would be relocating his hedge fund firm, Citadel, from Chicago to Miami for reasons that include a better corporate environment that collects no personal income tax, as well as the physical safety, interestingly enough, of his employees. Caterpillar has also disclosed in June that it's moving from Illinois to Texas. Manufacturers have increasingly turned to the Southwest as a destination for new factories drawn by the available space, appealing tax policies, and an expanding tech workforce in these markets where we tend to invest. Separately, factors that support the income resiliency of an office property include whether it's well situated, how well amenitized it is, whether there are single tenants that occupy a large percentage of the building, and the typical lease terms of the tenants, with shorter leases benefiting the most in an inflationary period with rising interest rates, costs, and generally rent rates as well. All those factors are consistent with Core's unique value propositions that we've been highlighting since the inception of the REIT. Moving to the next slide, you'll see a chart that shows the increase in tech worker jobs pre versus post-pandemic. As you can see, there's no slowdown in the tech job postings in the non-gateway states where Core has a presence or aims to invest. Slide 26 provides a brief summary of Core's sustainability achievements, and with a commitment to advance sustainability and to create value for unit holders, we'll continue to integrate ESG considerations into our operations. Finally, on slide 28, we close with a summary of Core's unique value propositions that set us apart from the other U.S. office S-REITs. Despite concerns over the U.S. office market as economic growth slows, coupled with the softening of some office fundamentals, we remain focused on optimizing Core's portfolio performance, leveraging our well-located assets in key growth markets across the U.S., and our exposure to the defensive sectors of technology and healthcare. And with that, I'll wrap up the presentation and turn it back over to Eileen.
Thank you, Dave. We have now come to the Q&A session. May I now invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the Q&A session. Participants, you may input your questions in the Q&A session here, and as well as our Facebook audience, please click on the link in the description box to join. We'll try to answer as many questions as possible. Over to you, gentlemen.
Thank you very much, Eileen. Very warm welcome to you, Mr. Snyder. Good evening, or should I say good morning? Are you based on the East Coast or the West?
Today I am on the East Coast, and it's fairly early in the morning, but much less early than it would be if I was home.
Okay, all right, very good. So thank you very much for joining us. At SIAS, we're always very grateful when the senior management of any company, joins into our conversations and helps to answer some of these questions. So very grateful for your presence here. We do have a bunch of questions that were pre-submitted, but the first one is really for clueless Singaporeans, and I'm really talking about myself. In your slides, you had referenced the term Sun Belt. What is that?
That's a great question, especially as a lot of not just Singaporean, but other Asian investors have that very same question. And it is a distinction for our portfolio. But the Sun Belt, as you look at the U.S., really stretches across the southern part of the U.S., where you tend to have much milder winters. you tend to have a coastline, so you have people that can really enjoy the ocean and other things. But it just it makes for an area in the U.S. where you've got warm weather. Typically, most of the Sun Belt states are also places where you're going to find a lower cost of living. You're going to find very enjoyable outdoors year round. And so we've been seeing people move into those Sun Belt states like Texas, Florida. Most would probably consider Nashville, Tennessee, where I actually am today, taking a look at one of our buildings here later on in the day. When the rest of the folks here wake up, I'll join them to go take a look. But these are the kinds of places that are considered Sun Belt in the U.S. And we've been seeing folks that have been moving their businesses moving into Sun Belt cities for quite some time out of the gateways in the U.S., which tend to be, with the exception of a couple cities in California, in the northern part of the U.S., with winters that are, let's just say, unpleasant compared to what we find down here in the South or in the Sun Belt.
Okay, I guess for us sunny Singaporeans, all we know is that Mr. Elon Musk is moving to Texas. Okay.
Yep.
All right. Okay. Back to the pre-submitted questions. There are quite a few, but clustered around 3 or 4 different themes. We'll just go through them in turn. So there's this movement from businesses recovering from the COVID-19 pandemic. So in Singapore, a lot of companies, or rather we have dropped our mask mandate and all kinds of other travel restrictions. Back in the US, how is the pandemic impacting the businesses of core, and how are the physical occupancy levels in the properties in your portfolio?
Yeah, it has definitely been a little different in the US than in Singapore. We lost most mask mandates well over a year ago, I guess, in the US. Interestingly enough, though, Singapore has gotten people back into the office even with masks on, and done a very good job of doing that with the various stages that we've seen folks going through as the government raises and lowers some levels. But in the US, I think what we've seen is a bit of a slower return to the office than you have had in Singapore, especially in the gateway cities where people still have not come back to the office. For our portfolio, on average, we're sitting just under 60% physical occupancy within the portfolio. But even in our portfolio, that varies quite a bit, with places like Texas, as you just mentioned, being our strongest when it comes to back to the office. And so some of those markets may be a bit over 60%. If you think about that, 60% would translate into 3 days a week in the office, essentially, for most employees. So we may be a bit above that in places like Texas. When you look at Bellevue, Redmond, outside the east side of Seattle, where we invest in the Seattle area, our suburban markets there, like Redmond, also are very well occupied physically. But the CBD in Bellevue, much like you find in the gateway cities, most of the cities in the US are lower. And so probably our lowest physical occupancy would be in our Bellevue CBD Plaza Buildings campus, while our suburban Bellevue campus and our Redmond campus have quite high physical occupancy. So it's been an ongoing bit of a change. We've seen that growing over time, each quarter on quarter. We've seen that improving, both generally across the US, but also within our portfolio as well. In my expectations, I would expect to see in general 3 to 4 days a week back in the office becoming sort of the new norm as we adopt, or we expect to see many companies adopt some form of a hybrid arrangement with their employees that will involve some period of time working at home, probably 1 to 2 days a week, and as well as the rest of the time probably being back in the office. So if we're somewhere between 60 to 80%, I think we'll probably be hitting basically what the new norm will likely look like in the office for most employees here in the US.
Okay. And I suppose the reason why Singaporeans, we go back to the office is because we are, I guess, live in fear of our bosses more so than the Americans. All right, so that aside, so a couple more questions here. There is a question about the rent reversion. So you had a slide about the increases in rent performing above expectations. So the question here is, what's your expectation about the rent increases? Would they be sufficient to keep up with inflation? I mean, obviously on paper it is not. So what are your thoughts around it?
Yeah, that's going to be an interesting one to see how that pans out, not just for us, but across the U.S. in general. Um, the market rent increases that you see in different markets are driven primarily by the office fundamentals in those markets, but inflation does play a role. So in some markets, we're going to see relatively flat rents. In ours, that's the case in maybe Houston, probably, I would say, is the one market where we're continuing to see flat rather than growing rents. When we look to where you find the most significant portion of our portfolio, that's going to be in that east side of Seattle, Bellevue, Redmond area. And we continue to see, strong rent growth. And we've continued to see that even through the pandemic. As one of our slides showed, I think CoStar's projections were negative and we achieved something over 4% growth in those markets. And that's CoStar's overall reading. Our specific results have been pretty close to that, I would say. But we've seen quite positive rental reversion in that sort of Bellevue, Redmond area, as well as some other markets. And it's been a little slower in some. But we do expect in a sustained environment where you're continuing to see inflation, that the rent levels will continue to grow. Whether it's an exact offset is hard to say. If you think about what really our costs are that are inflating. So for us in the US, that's going to be putting in tenant improvements to build out the space for our tenants, which is a little different than how it works in Singapore for office space. But if those costs are escalating at, call it, 8 or 9%, somewhere in line with US inflation, and that is pretty much what we've seen. That is typically a one-time cost. Typically, we would be signing 3 to 5 year leases. A lot of our competitors may sign longer leases because they are in markets that aren't quite as strong as our key growth markets, that don't have as strong of rental growth. So in a market where you don't have rental growth very strong and your built-in escalators are low, you're okay signing a long lease. For us, where we've got strong rental growth, especially in, say, that Bellevue, Redmond, or in a couple of our other tech-dominated markets, we'll see rental growth that exceeds that built-in rent growth that we have. So we want shorter leases so we can mark back up to market. But if you're up, call it that 9%-ish level on those costs, if your rent is going up by a few percent per year, given that your rent is kind of across the whole portfolio, your costs are just on the cost to put them in, that's kind of a break-even basis. And as we saw on that one slide, we're certainly beating that in a few of our markets. Well, some of the others, it's probably going to be a lot closer to kind of a flat impact. And we may have one or two where it goes the other way. But all in all, as time goes on and we continue to see rising inflation, our tenants get it, if you will, that their costs for rent are going to do the same thing that the rest of their costs are doing and escalate. And so I do expect, while it's a little bit delayed, that you do see sort of that catch-up response in rent levels over time when you're in an inflationary environment. And that's what we've typically seen in the past as well.
Okay, so diving into what you mentioned just now about tenants, there is a question about whether or not the portfolio contains particular anchor tenants. So for example, like in Singapore, any kind of retail mall would generally have a supermarket and a cinema chain and a food court. Those are the anchor tenants. Is that the same business model that Core is pursuing?
So for our business, we really don't look for strong anchor tenants within our buildings. Most of our buildings are multi-tenant. One of our actual key strengths is the fact that we have so many different tenants. We had a slide that talked about our low tenant concentration risk. So, if you look at our competitors' portfolios, you're going to see much higher tenant concentrations. Our top 10 only represent, about 23% of our portfolio. Our top tenant is only about 3.4% of the portfolio. So we don't have any tenants that I would say are, sort of an anchor tenant within our portfolio. And we do have a few buildings where we have, call it one major tenant that takes up the majority of the building. We have a couple of those in our top 10. So Comdata does take up the majority of the building that we have in Nashville. And then GoGo Business Aviation does take up the majority of one of our two buildings in Denver. And those were both acquisitions that we made in 2021. But in both those cases, again, Comdata still only makes up for the portfolio 3.4%, and GoGo makes up only 2.7% of our portfolio. So even in a building where we have significantly one tenant, on a portfolio basis for us, it's still just not significant, which is, again, part of our design, if you will, and part of our focus is to maintain that, because there's just a lot less risk for our unit holders, for us, from a leasing perspective, when you don't have really big, significant tenants within your portfolio.
Sure. I mean, I can relate to that. I mean, that's called diversification in the capital markets. Yeah. All right.
Yeah.
Cool. All right. There are a bunch of questions about the performance of the stock price. Specifically, it's has not been performing as well as expected, and there was one question about it not being above its price to book. So perhaps the question to phrase is, what would be your outlook for the portfolio, as well as business plans around expanding the business and driving up the stock price?
Yeah, interestingly enough, the second part of that question and the first part don't go exactly hand in hand, with the stock price performance not being what I would have expected over this time frame. When we've been outperforming the U.S. on the office market front, we've been outperforming in terms of our performance, occupancy, DPU growth, and other things, outperforming our competitors, direct competitors, at least in Singapore as well. I would have expected to see a different story. I think there's a fairly broad brush approach, if you will, that we're seeing as it relates to the U.S. office REITs in Singapore. And so I think some of the declines that our competitors have seen in occupancy and some of the other issues that they've had to be dealing with as it relates to certain of their large tenants, that have vacated space and things like that. I think that seems to be impacting all of us, unfortunately, because when we look at our portfolio and our performance, I can't find the reasons why, our stock price or our yield are where they are. That does make it more difficult for us to invest in the U.S. Well, when we're running at a yield north of 9%, it's a little complicated to try to invest in most of the markets that we would like to invest in the U.S. We launched this REIT at something closer to a 7% yield. Since then, they're obviously over the last couple of years, we've had the pandemic, we've got interest rate concerns, we've got a lot of other things that have just continued to pile pressure on the company. I think as that starts to stabilize, as inflation does start to come down, no way of knowing how quickly the Fed's going to be able to combat that, but they're certainly trying with the 75 basis point increases that we've seen. And I think, as Geoff mentioned a little while ago, that we expect to see more of. Hopefully that will get back in line. Hopefully that will take some of that overall economic pressure off and see our stock price start to trade at maybe a more normalized level as it had prior, maybe to the pandemic, where we can eventually get back to investing into the markets that we like across the U.S. markets where we already are, places like Salt Lake City, another key target market for us. North Carolina, there's places like Charlotte, North Carolina, Raleigh, Durham, Nashville, where we recently invested, that are other key growth markets for us. And so, I do expect as things normalize, you'll see us start investing in those markets again. The one, I guess, thing that's a positive there is that we're not really missing out, because at the moment we're not seeing trading of property in the U.S., not of office property. With interest rates where they are, with banks being a bit leery in the U.S. of lending against real estate transactions, we've seen a significant slowdown, if not almost shutdown, in the trading of office buildings in most markets in the U.S. And so I think we should have the same triggers that reopen those markets, as well as get our stock price back down, or rather our stock price back up and our yield back down to levels where we can be back in and acquiring in some of those markets, as we do expect to see some fairly attractive options hopefully coming into the marketplace later this year and into next year.
Okay. In your presentation deck, you had a slide that showed the impact of higher interest rates in the US vis-a-vis the change in the DPU, the distribution per unit. Is that does further changes in US interest rates or monetary policy change the number that you had estimated? I think it was minus 0.06 cents or something.
That's correct. And so for every basis point change of 50 or 50 basis point change in rates, that's about what the impact should be. So it's not very big really for our portfolio. And again, that's because we have over 80% of the portfolio currently hedged with floating to fixed rate swaps. And so, each interest raise of that amount, and so if it's 75 basis points, you could basically take 1.5 times that 0.062 US cents change, and that would give you what the impact would be from a 75 basis point rate hike. It should remain relatively consistent as those rates go up, or as rates come back down again, as may very well likely be the case in the not too distant future, given the pace the Fed is raising rates and what some of the likely outcomes may be of those quick rate increases that we're seeing.
I mean, quite possibly by this time next year or end of 2023, we're going to see a huge reversal in the Fed funds rate, right? Then the story is going to go in the opposite direction.
That could certainly happen. It will be very interesting to see how well they're able to tailor this as they try to come up with this soft landing. But I think I would lean towards you that it probably won't be as soft as they'd like, and we probably do eventually see some reversals here in the not too distant future. Okay. But better to get inflation in hand and get the economy corrected than to take this too slow, like I would tell you I think they had done up until fairly recently.
No, totally agree. They should kind of front load it, get the pain over with, and then we can
exactly
get things back on track. Okay. There was also a something that you had on slide 27. So core was ranked second out of 45 in terms of the governance index. Could you elaborate a little bit more on that, the governance index?
Yeah, there's actually a couple different indexes that are used that we reference in our presentation. I'm trying to flip to this in front of me here. So we've got the governance index for trusts, where we come in second, and so that is run in Singapore, and it just compares all of the REITs in Singapore, of which I believe it's about 45 or so. And then we've got the Singapore Governance and Transparency Index, which we also get rated, and we come in 9th out of the 45 S-REITs on that as well. And so that really is just pointing to sort of transparency of what we do, what our unit holders are able to see, vote on, things like that, the structure of our corporate governance, diversity, a number of other, there are a lot of factors, and they vary a little bit between the two, hence we ended up with different score in both. But as a small REIT by S-REIT standards, and as a relative newcomer by S-REIT standards again, we felt great about the performance on both of those. Hence we highlight them on here just to show that we really do try to be responsive and transparent for folks. And one of the recent changes that I talked a little bit about here of changing the way that we pay our management fees from being paid 100% in units to 100% in cash. It's another one of those areas where we would like to be transparent. The reality is those costs are real, and whether we're issuing units, which when we have a stock price is trading below our NAV, is going to, in at least in a minimal level, dilute the unit holders. Switching that to all cash, which gives you a very clear, transparent actual number for DPU, DI, yields, all of that. We really felt like that was one more way that we could be more direct, clear, and transparent with our unit holders, and hence we made that switch, even at a difficult time with the economy not doing well, just because we felt like, that transparency, that giving people a true number, unlike many Singapore REITs, which still pay anywhere from a small portion to 100% of their fees in units, it ends up sort of just disguising the reality of where your yield is. And while our larger institutional investors, I'll take that into consideration, I'm not sure individual investors are always completely aware. And so, again, we wanted to be clear, and we made that change. And hopefully that's the sort of thing that will reflect well in some of these other indices, if you will, where you get rated versus other REITs too.
Great, cool. Well, on behalf of all retail investors, I would say that cash is king. So that transparency is a huge plus. Okay. There is a question here about additional equity fundraising. So in Singapore, once in a while, REITs will offer structured warrants, so and so forth, basically to raise more funds. So the question here is, would shareholders of Core expect any equity fundraising activity in Singapore? And of course, totally understand if you're not able to fully disclose any specific details.
Yeah. Typically, if we're going to be raising more equity or issuing new equity, that would be in relation to an acquisition, generally speaking. And so given what I recently mentioned a moment ago about the acquisition market in the US and where our stock price is currently trading, it's probably not imminent that we would be doing that. But we would certainly hope, as we get towards the end of this year and into next year, to be in a position to be buying assets and to be raising more equity, which we would expect that to be done, generally speaking, in Singapore, giving our current investor base and new investors both the opportunity to participate in any future equity raises that we have. We'd definitely like to see both. We love giving the current investors the opportunity, and Singapore has, to me, at least coming from the US, something I've never seen. They've got a very unique structure where we can just make that offering to our existing unit holders, whereas we can also at the same time do a placement to bring in some new investors as well that haven't had the opportunity. And we've liked being able to really balance that in the past, and that's what we would like and expect to see in the future as well as we do equity raises.
Okay. Well, I think we only have got time for one more question, and that would be risk factors. So apart from what we had discussed about interest rates and occupancy rates and so on and so forth, do you see any further risk factors that might impact the outlook of Core?
I mean, I think the biggest risk factor is probably the obvious one that I touched on a little bit with occupancy, but as we're looking out to our tenants and they're looking at what do we need to do to bring people back to the office. It has been very difficult, especially for tech tenants, to bring their employees back to the office, because a lot of them say, hey, if you tell me I've got to come back to the office, I'll find somebody else who will let me work from home. It's not just tech, but the tech companies have been where we've seen the most competition in that area during the pandemic. One of the interesting results that we're seeing of sort of the downturn in the US economy, if you will, has been many companies saying that they're having a hiring freeze, including the vast majority of tech companies. Again, I want to be clear, a hiring freeze is very different from firing a bunch of people. So a hiring freeze simply means we're good with what we have for the moment. We're going to wait and see what's going on. We'll hire as needed. But it has made it very difficult for employees in the US who have had a lot of power for several years to say, if you tell me to come into the office, I'm going to move, because guess what? Nobody's hiring for your positions anymore. And so I think what we're going to see is a lot more of our tenants able to get their employees back into the office. This is going to give them the ability to solve the question that's on all of our minds front and center. What does the new world look like? Are people in the office 3 days, 4 days? What does that look like? How much space do we need if that is the case? And so, I think that is probably my biggest concern, is how that fleshes out over the next, probably call it another year, as we see the major decisions being made. And when you look at not our major tenant base, but typical office users, a lot of professional services, law firms, accounting firms, consultants, those types of companies, a lot of them are probably going to shrink their space, call it 20%. We're expecting that to happen. We've got short lease terms at Core, and so we've already seen a lot of that happening as we go. A lot of our tech tenants are not shrinking by the same amounts, but here and there you have one that shrinks even more than that. During the first 2 quarters of 2022, we actually saw more of our tenants expand than contract, which was great, but will not be the case every quarter. In general, it's going to go the other direction. We've just been fortunate with our tech tenancy and portfolio. So I think as we wait to see what that looks like, that's the biggest concern. But I do expect overall we'll see some declines with a lot of tenants that shrink space, 10 to 20%. We'll see others that grow. It's going to be very business dependent. But given our locations, given our types of tenancy, we do expect to continue to hold up much better than the peer set in terms of overall occupancy. But that's the big one. And when I do say that some will expand, for those that are listening, going, but why would they do that? A lot of our companies are growing companies. They have to expand not just for their current employee base, but they are hiring more overall. And so, they're expanding for that reason, and also to provide a maybe more useful, flexible office space where you've got more what I would call huddle rooms, small conference rooms where people can collaborate, work together. What we've seen, what you've seen in Singapore is a lot of movement to hot desking and things like that. Companies tout that as being productive, and it's just not. I mean, the reality is you can't really collaborate in those spaces because you're too loud for everybody around you. So we think those kinds of spaces and rooms are going to be helpful. There'll be probably some shrinkage in some areas and probably expansion of that. The other big change we've been doing in our portfolio is adding amenities to the portfolio during the pandemic. Because that's the other thing, that as the best companies that want to bring their people back, which almost all companies do, is what's going to be there to draw them into the office when they've been used to being at home. And so we've improved our amenity base at several of our buildings, quite substantially. And, I think, that's one of the ways that we combat some of this risk and help our tenants do the same thing. But, we don't have all the answers yet. And over the next year or couple of years, I think we're going to see that play out. But we've tried to be nimble during the pandemic, and we will continue to try to be nimble and provide all the things that our tenants want for their employees on a go-forward basis as well.
Okay, and when you talk about enhanced amenities, we're not just talking about bean bags and pinball machines, right?
No, we're talking about things beyond that. We've got
I'm just
some
pulling a
where,
leg, yeah.
No, yeah, but some people might not have any idea what we mean by that, right? So it's a great question. In Seattle, we had what I would call a not in our downtown Bellevue building, a not that nice cafe previously, which has now been turned into pretty much the nicest spot in competitive set buildings, with the top coffee provider and chocolate provider in the entire Pacific Northwest now providing the services, a group called Dilettante. And they have completely upscaled everything about that and made it match the rest of the building. In Houston at 1800, we have completely redone our space on the ground floor, bringing in large training room that's brand new and built out incredibly well. Meeting rooms, common area, sort of a grab and go food service, just some open areas for folks to meet on the top floor of that building to we provided even higher end amenities and built out a bunch of spec suites, or fully fitted out space, if you will, that tenants can take immediately. But that have an amenity set where we, quite frankly, we had the Houston local news filming a segment on what's going on with offices, and they chose to film a significant portion of that in our 21st floor amenity space because they haven't seen anything like it in the city of Houston. So we really try to be top end, but at some of our other projects, we do have things like volleyball courts, basketball courts. Our tech tenants love that. Big tech tenants provide it on their own campuses. Our smaller tech tenants love that our campuses can provide that same look, feel, and all the rest of that their employees would find if they went to a bigger tech company. And so we try to provide a lot of those same sorts of amenities and options at our buildings throughout the portfolio, and we try to improve it as we go.
I would love to see that, actually. I mean, Seattle is well known for its coffee, right? I mean, if you have the best coffee in one of your buildings, wow.
Our head of asset management, and this sounds crazy to me as a non-big coffee person, but most Singaporeans I know are big into coffee, and this would probably make sense in Singapore. When our asset manager for those properties goes up to Seattle, he actually brings a large container, fills it with Dilettante coffee, and brings it back to California for his wife. I don't get it, but that's how good it apparently is.
Okay. All right. Thank you very much, Mr. Snyder. Sorry. So very grateful you could join us. Really enjoy our conversation. Hope to see you on our programs more often, and hopefully, we can help you get your word out. About how great your portfolio is, and
Well,
hope to see you
Benjamin,
more
thank
often.
you so much for hosting this, for moderating, for the questions. We really appreciate SIAS being able to bring us in and letting us have this opportunity. This is great for us. You guys do such a great job with doing similar programs with so many different companies. Very informative. All the things people can find on YouTube, on your web, elsewhere. But we really appreciate the opportunity and for you putting this together and inviting us. So thank you so much.
Thank you. Over to you, Eileen.
Thank you, Dave, for the good word. We have come to the end of the session, and for everyone for joining us this evening. In case you missed any part of today's session, you can rewatch on SIAS YouTube or on Facebook. Do visit our SIAS website to get updates on our upcoming investor education program. And I also would like to promote that our next flagship event, which is the Corporate Governance Conference 2022, happening on the 10th of October. The link will be provided in the chat box. Tickets are on sale now, and we look forward to seeing all of you. Thank you and have a great evening. Thank you.
Thank you.
Thanks very much.